Today, we will talk about exchange of futures for physical, EFP. Exchange of futures for physical is a private agreement between two parties to trade a futures position for the basket of underlying actuals. This can be used to open, close, or switch a futures position for the underlying asset. EFP is a privately negotiated agreement that can then be registered with the exchange. The volume involved in the transaction is shown in the day's trading when the transaction is registered, but the price at which the transaction was completed is not revealed. EFP is also referred to as exchange of futures for product and exchange of futures for cash. It is generally used to describe transactions of this nature even when the underlying are financial products rather than cash commodities. The most common examples of the exchange of futures for physical is in the oil and gas sector. EFPs will usually involve large commercial and non-commercial traders. Imagine an oil and gas producer with an inventory of 1 million barrels. A refiner who is worried about prices wants to secure barrels of oil in the future, so they buy contracts representing a total of 1 million barrels. They agree to a price and delivery date in the future where the producer hands over the physical oil to the refiner, locking in the refiner's supply, and receives the futures in return, allowing the producer to continue the bullish position on oil prices. EFP allows for large, offsetting transactions to take place at a decided price outside the market pricing mechanism. It is also used when the market depth is not able to absorb the transaction. EFP is especially useful for preventing large transactions from artificially altering the market price. Here are 3 key takeaways. 1. An exchange of futures for physical, EFP, allows for one party to swap a futures contract for the actual underlying asset. 2. EFPs are traded over the counter, OTC, and are often used by commodities producers to hedge positions or regulate production. 3. EFPs are especially useful when a large transaction takes place so the market price is not artificially altered by a non-speculative trade. Hope this would help. Thanks for watching.